Hello, hello. Hope everybody is doing well. It is Wednesday, November the 17th. I haven't seen you guys in about 2 weeks, so I hope everybody is doing well and having a good start, I guess, to the holiday season. Starbucks says that it's the holiday season, and I'm on board with that. I'm on board with that. I just got this is actually, I think, the first time I've gotten it since they've switched over the cups. So this brought joy into my life today. So let me know when you get here so I can make sure that the broadcast is working. Sometimes Facebook likes to have some technical difficulties. So I just want to get the go ahead from my team before I start chatting it up. So tell me you're here, say hi if you're watching this. Today we're going to be talking a little bit about tax planning. And I am not a tax planner myself, but I am a CPA, so I know a little bit about tax planning. And I want to talk to you about what it means in the context of year-end tax planning, and what I am doing right now to make sure that I'm going to be in good shape for taxes. So I see some people on, but I'm seeing some comments. Make sure if you're watching in the Facebook group and you haven't before, make sure to hit the little there's something that tells you to give StreamYard permission to see your name. My team can probably share what the link is too if you don't see that. But today, the reason that I wanted to do this was because I'm actually going through, I think it was last week, I sat down, I spent an entire day, super fun, doing all kinds of tax planning activities. So I was trying to make sure, okay, what do I want to do? What impact do these choices have on my current year taxes, but not just my current year taxes? And we're going to talk about that. So I'm trying to make the best decisions within the next, call it a month and a half for what's going to help me in the long run pay the least amount of taxes due responsibly, right? Because you guys know one of the things that I really harp on a lot here, if you've been around for a little while, is the fact that what I don't want you to do, before we even get into what I want you to be doing right now, what I don't want you to do right now is scramble and freak out because, I haven't paid my estimated taxes, or I haven't been saving for my taxes. I know I'm going to have a big tax bill come April. Now I'm going to go spend a whole bunch of money on things I don't actually need between now and the end of the year in order to get the deduction for it. Because let's remember, right? A tax deduction doesn't mean you get back 100% of that money. You get back the amount you paid times your essentially top end tax rate, right? So call it, let's say 25%. If you spend $100, you might get $25 back for that on taxes, but you still spent $75. And if you spent that money on something you don't actually need and isn't actually going to help you further your business, then it really wasn't a good choice to make, right? So that's kind of number one, the don't. The don't when you're doing tax planning is don't use this season as a reason to go buy all the things, and especially if they aren't things that you needed anyway. Okay? So that's the first don't. So let's talk about the do's. If you're sitting here and it's the middle of November and you're trying to decide, what do I need to be doing, right? I get that question a lot. Like, what do I need to be doing? Well, I think it is always good to sit down with a tax planner. So like I said, I'm not a tax planner. I don't know your situation. I'm just going to walk you through what I'm doing. But I do want to tell you, right, that the big question you need to be thinking about first, the big question before you decide what you're going to do and before I even talk through what you're going to do, the first question is, I want you to think about what you expect your total income, and that includes your family income too. If you're married filing jointly, right, that would be your spouse's income too, added into that. Your total income, so any of your business profits, remember profit is what we're taxed on, not revenue. Revenue minus deductible business expenses equals profit. So take your profit plus any maybe salary wages that you have, maybe salary wages that your spouse has, maybe investment income for investments you've actually sold and realized a gain for, anything like that. You want to kind of add that up, figure out, and this can be a rough estimate, how much income am I going to have this year, right? Estimate it out. You can even look at old pay stubs, figure all that out. Estimate that out. Then I want you to think, and this is going to be harder, but I want you to think about next year. And I'm not going to ask you to think 5 years in the future. You can if you want to. You can get a general idea if you want to. But right now, I want you to think about, what do I expect next year to look like? and be reasonable, right? Use what you know about your business or your financial situation to decide, what do I expect? What do I expect to happen, right? So, and I would kind of estimate out that income as well. I know we don't know. I know, especially as business owners, we don't really know what next year is going to look like, right? Especially when we're kind of coming on the heels of a pandemic. Like, who the heck knows? But I want you to get a general idea of, do I expect my income to be higher next year, or do I expect it to be lower, right? And we're talking about profit. Remember, we're talking about business. So I want you to think about that. Think about, are you planning to make investments into your business next year, possibly? What do you have going on next year that you want to be taking into consideration? And think about, okay, is there a substantial difference? If it's roughly the same, then you don't have to worry so much about it. But if you think there's a decent chance you could grow a lot next year, right? Like, you have plans to grow a lot next year from a profit perspective, and you're seeing that trajectory towards the end of this year, and you're thinking it's going to be significant, and you're like, okay, I need to pay attention to that. When you're doing that, right? If you're saying next year is going to be significantly higher income wise, which means you probably would be in a higher tax bracket for the top of what you're, remember, it's only the pieces in between the brackets that are getting taxed at that rate. But whatever that top end rate is, that, the highest money that you're making goes to that top end rate. If you think that's going to jump to the next tax bracket, then I want you to think about this even more clearly, right? Because our inclination is to always want to save taxes in the current year. Our inclination is to always say, no, I'd rather pay less taxes this year. Why? Because that's what's on our brain. Right now, you're thinking about what you're going to have to pay between now and April of 2022. You're not thinking about what you're going to have to pay in April of 2023 or all next year, right? That's not on your mind yet. But I want you to have at least that much like forethought on what's going to happen, because I've seen a lot of business owners almost shoot themselves in the foot trying to take all of the deductions they possibly can in the current year, but forgetting that actually maybe some of that would be better next year, right? So the first thing to figure out is, where do you want those deductions, right? What's going to save you the most in taxes? And if you think next year's tax rate is going to be higher, you might actually be in the situation where you want to take some of those expenses that maybe you were going to pay out, between now and the end of the year. You might want to wait until the first of the year for those. Okay. So again, if you're in the boat where you expect business to grow significantly and maybe bump you up into the next tax bracket, then you'd probably rather have more deductions next year to offset that additional revenue, right? So if you go on a spending spree and buy a whole bunch of stuff this year that you could have waited until next year for, right? Then that could come back to bite you. So that's one of those situations where we're looking too short term on it, where we're just like, no, I just want to spend right now so that I can get lower taxes. Now, if you expect this to be actually the higher year for you, then it would be the opposite, right? If this is going to be the higher year for you, if you expect revenue to actually go down next year, maybe you had a big year this year, right? For one reason or another, and you don't expect that to continue, or you expect to be investing further into your business next year, then at that point, you probably do want to have more of those expenses. So you want to look at, okay, what's going out the door in like January, February, March of next year? Can I pull that forward? Now, as a CPA, I have to kind of put the asterisks on this and warn you that make sure to talk to an accountant, especially about those big purchases, right? So if you're thinking about buying a big machine or a car or a million other things that are kind of those big asset purchases, sometimes, right? Sometimes when you buy it is not going to be when you actually get to deduct it. So you want to work with an accountant about what makes the most sense, what you can do, what makes the most sense for you to do, right? But I see people doing that sometimes. Inventory is another one of those things where they maybe buy a whole bunch of inventory, but the truth of the matter is inventory actually hits in your taxes when it's actually sold, not when you buy it, right? So you want to make sure you understand the rules there. But in general, for me, for example, I actually do believe that next year is going to be lower on the profit scale for me than this year was. Why do I think that? I think that because we have plans to reinvest into some things and some development that we are doing within the business next year. So I'm actually at a place where I do want to pull some of those expenses forward. So I've been doing things like paying off my software. So I have a course hosting platform that I use, Kajabi. I normally pay it monthly because That's how it started, and I never went back and changed it. And so I went and paid for that platform for the full year, which gave me a 20% discount by paying for the year all at once. I know I'm going to use it, so I might as well get that discount. And it also allowed me to pull those expenses for next year into this year. The reason I can do that is because I'm a cash basis taxpayer. Most of you probably are too. If you're not, you probably know it, right? If you're an accrual basis taxpayer, you probably know that. If you have no idea what I'm talking about, you're probably a cash basis taxpayer, meaning in 90% of cases, you are paying taxes when the cash comes in or when the cash goes out the door, right? That's when you recognize the revenue and expenses, when the cash actually moves. Not when you invoice somebody, right? When the cash actually comes in, that's when it's income to you. So that's important to know. But if you're a cash basis taxpayer, we have some leverage, right? Like we can pull some strings on the cash piece of the business from a timing perspective that could have an impact on our taxes. So that's the first thing is, again, make sure you know which year do I expect to be in a higher tax bracket. If it's the same, okay, fine. Then you probably want to focus on this year first. If you don't expect meaningful, significant changes, then yeah, let's figure out like maybe it's time to reduce this year and we can worry about next year. But if you know next year is going to be higher, then be careful shooting yourself in the foot by bringing too much into the current year. Similarly, we've talked about expenses, right? And the timing of expenses. So we have a lot of control over that, especially things that are coming in December and January, right? If there are things right in that zone, you probably have a decent amount of control over when you actually pay those things. Some things not so much, right? You don't want to like delay your payroll that you're going to pay people. That's not a good idea. But there may be certain things that you can prepay, things like that. Then let's think about the revenue side of it, because that's the other side of the formula, right? Revenue minus deductible expenses equals profit, which you pay taxes off of. On the revenue side of things, you want to be thinking about, okay, if I know that I want to, if I know that this year is going to be lower, right, a lower tax rate than next year is going to be higher. How do I pull some of that revenue from next year into this year, or make sure that I've collected all my revenue for the current year, right? You want to collect it in the current year. Now that will have the impact of increasing your taxes in the current year because you'll have to recognize that revenue. But number one, you get the cash in, which is always a good thing, right? And number two, you've pulled the revenue into this current year, which is lower taxed than what you expect next year, where you don't want that revenue because it's going to cost you more next year. Just between December 31st and January 1st, there can be a big difference depending on what changes in your business. So I hope that makes sense. So you want to think about, okay, I need to go collect. If you've got outstanding invoices that people have not paid, right? And you want to bring that revenue and make sure you collect it in this year, you need to go on a frenzy to collect that revenue. If, however, you're on the other side of the coin and you're like, no, I actually think next year, like this, either the years are going to be the same, or I think next year, I'm actually going to be in a lower tax bracket, right? If you think next year you're going to be in a lower tax bracket, then you are going to want to do the opposite, where you're like, how do I delay my revenue a little bit? And I will tell you, like I said, because we're expecting next year to be lower on the profit scale than this year because of some reinvestments we're making into the business. Because of that, I'm in this spot right now where you will not see me really launching anything between now and the end of the year. I'm going to wait till next year to really be launching and selling, because that's when I'd rather bring that in maybe in January or later than right now. Okay, so I'm thinking about ways to kind of delay that. Maybe it's payment plans, right? Instead of taking money up front, there's payment plans, which can allow you to spread that over time and also can be good for your customers, right? So we're thinking about things like that when we are considering when to bring in that revenue, when to collect it. Maybe there are some outstanding invoices, maybe not at this point, but like maybe, you send invoices in December, and if people don't pay you, maybe you wait to chase them until January, right? Maybe. And that may also align with kind of the interests of the person on the paying side who might be like, I'd rather pay it in January, right? Depending on what those interests are. So there are a lot of things that you can do around kind of that year-end time frame, but you have to first start by knowing what your goal is, right? And the goal is not like the short-sighted goal is I just want to pay less taxes this year, but don't let that shoot you in the foot for next year, right? And that can be the goal. That can be the goal, but you don't want to shoot yourself in the foot for next year if you expect significant growth. That's one of the things I always have to remind people. And you can look into the future too, to say like, oh yeah, I expect my business to keep growing, in which case the more you can put in this year, the better, at a lower tax bracket, right? That means it's yours forever. You paid a lower tax amount on it. And you don't need to, and you're never going to be retaxed on that, right? So those are kind of the thoughts when you're talking about timing of revenue and expenses around year end. So avoid the pitfall, avoid the pitfall of, I'm just going to spend a whole bunch of money between now and the end of the year because that will help me on my taxes later. Here's the problem with that, right? Here's the problem with that from a cash flow perspective. If you don't have the money to pay your taxes right now, you certainly don't have the money to spend a bunch more of extra money and then try to pay your taxes, right? Because like I said, yeah, sure, when you spend money, you're saving a little bit, right? Maybe you're saving $20 or $25 for every $100 you spend, as in you'll get that back on your taxes, but you still spent the rest of it, right? So you have to have that cash flow and you're still going to have to pay your taxes. So you have to be really mindful of what the tax situation is too. I'm really big proponent of paying estimated taxes if you can, and also even if you don't pay estimated taxes, or even if you do, saving a little bit extra in a separate account that is meant for taxes. I find that people make much better business decisions when they're not strapped for cash and when they're not panicking about the tax bill that they're going to have to pay. People make not great decisions sometimes for their business when they are worried about the tax bill at the end of it. Don't let the tail wag the dog. All right. So I'll say I'm giving you tax tips, but what I mean by that is don't let the accounting treatment, don't let the tax treatment, right, dictate what's best for your business. Start with what's the best move for my business, and then how does this impact taxes? So that's really important because a lot of people don't let that dictate. Don't do things just because of taxes. Do them because they're a good move for your business and hopefully also have a tax benefit. And even if they don't, if they're a good move for your business, it's a good move to do, right? But the timing element, for sure, you have some impact there, and just moving things, a couple days or a week can make a big difference potentially on your tax bill. All right, what's the last thing? The last thing I wanted to bring up as well, outside of the timing of revenue and expenses and really being mindful of where you want that to go, right? What year do you want to recognize it in, and being mindful about making that happen as much as you can and within reason. Don't get cute, right? But the other thing is retirement contributions. And so this is a great time if you do not have a, self-employed retirement account, a traditional IRA, a solo 401k, whatever, a retirement plan, right, that you can contribute into. And even if you have a traditional IRA, you may be able to set up a SEP IRA or something like that as well, that has higher limits. So I recommend talking to a financial advisor. Now is a really, really good time to do that. I have a few of them. Crystal, you can post the preferred vendors list if you want to on here so that I can share if people are looking for a advisor to sit down and create these accounts for them or help them figure out what they need, right, and what's best for them. But as long as typically, now it changes depending on the type of account we're talking about, but typically, and I am not a financial advisor, so asterisk, this is not financial advice. This is this is just me telling you what I think, what I'm thinking about right now. But you want to, between now and the end of the year, have that account set up. You usually have through the first few months of the year until you file your taxes to make the actual contribution for the current year. So you don't have to make a contribution to your retirement account by the end of this year. They do that in some ways because, for example, for us self-employed people, usually the max that we can put in is based on a percentage of our profit. And we may not know what that is by December 31st, right? We haven't gone through and fully figured out what our profit is to the dollar. So we have time to figure out our profit and then make those contributions in the first part of the year. But you usually do want the account at least set up by the end of the year. Those are great tax vehicles, okay? So especially now, we're going to go back to what's the point again, right? If you want to lower taxes for the current year, right? If you want to lower taxes for the current year, likely because maybe you expect next year to be about the same, or you don't expect any significant increase. You don't think you're going to be in a higher tax bracket next year. So now you're like, okay, well, I'm just going to focus on reducing as much as I can this year. Then that's a good time to max out those retirement contributions in tax deferred plans. Tax deferred plans are the kind of plans where you put money in tax free and you get the deduction in the current year. And it grows. And when it grows and when you take it out, you do have to pay taxes, right? So that's something like a SEP, that's something like a traditional IRA or a traditional 401k, right? Those are usually, you get the tax deduction in the current year whenever you put the money in, but you do get taxed when you take it out, right? The other, so that's a good one that will reduce your taxes, those types of retirement accounts that are deferred. Now, the other type of retirement accounts that you'll see are things like Roth, like a Roth IRA that works the opposite way, where when you put the money in, you don't get a tax deduction, but that money grows tax-free and you can take it out without paying any taxes, right? So again, that can be really helpful if you expect it to grow quite a bit between now and when you take it out. A Roth is a great option. Now, Roths tend to have lower minimums, right? You're not going to be able to put as much in a Roth, unfortunately, as you can in some of these other plans. But again, that goes with what are you trying to do, right? What is the goal of what you're trying to do? And if you are in a year where you know that it's going to be a really low tax year, like maybe you're in a loss position on your business or like very little profit because of all the things with COVID, this may not be the year to go put a whole bunch of money into your 401ks, right? Or your SEPs. Why? Because you're not really getting much benefit from it. You're putting that money away where you can't touch it, which has some benefit, right? But I like to be able to get my money if I need it, unless I'm getting a benefit for not. So you don't want to put a whole bunch of money into a retirement plan if you're in a very, very low tax rate, right? It probably doesn't make a lot of sense. There's probably better uses for that money. Maybe a Roth, right? Where you're putting that in and you're paying the taxes now, but it's going to grow tax-free. And later on, when you're in a higher tax bracket, you can take it out tax-free. So that is an option for you. So again, you want to know what the point is. What do you expect your income to be? Roundabout, what do you expect your tax rate to be? And that's something you can work with a tax planner to figure out. This is also a really good time of year to be sitting down with an accountant to figure out, okay, here's how much income I've recognized so far this year. Here's how much I'm expecting for the rest of the year total for my family. Here's how much we've paid in withholdings and estimated taxes, right? So that you can figure out what if you're going to have a tax bill to pay later and what that's going to be. Because a lot of times, even if you're making estimated tax payments and your accountant is making them for you, they're basing it on last year. They're not always basing it on the current year. Okay. So that's important to know, especially if you had a really crappy last year, which a lot of us did, right? If you're paying estimated taxes based on last year and you have a better year this year, which a lot of you do, your estimated taxes may not cut it. And you may be stuck paying a big check at the end of the year or in April, right? Or whenever you file your taxes for that reason. Okay. So think about that for sure. Think about sitting down with somebody and doing out that reconciliation. That's something that I'm doing. I'm a CPA, so I can do it for myself, which is great, but it's also not super fun for me. So I'm sitting down and doing that work myself. So I'll post the preferred vendors list here. Preferred, if you are looking for a financial advisor or anything like that. I believe that's the right one. Let's see. Yes. And this is a great question from someone who's on our preferred vendors list. Don't worry, I'll put the preferred vendor back up. But April's on our preferred vendors list. She is a bookkeeper. And yes, the more organized. So if you're like, how am I supposed to work with a tax planner? Because I don't even know what my profit is to date in my business because my books are a mess and I haven't looked at them since March, right? If that's you, then now is the time. You do not want to wait till January. I'm going to say it again. You do not want to wait till January to get your books in order for taxes. You don't want to wait. Well, a lot of people wait till March, right? But you remember there are things like 1099s you're going to have to send out by the end of January, W-2s, all of that. You're going to want to be in good shape. Plus all the good bookkeepers And all the good tax people are going to get booked up. And so if you try to come to them on, January 30th, they're probably going to be booked. If you try to come to the tax preparer on April 10th, they're going to put you on extension, right? So I would make sure, Christina's another one. We got lots of our preferred vendors on here. Yes, April's like, we will be booked. We will be booked. Make sure to do it now. Get things in order. You don't have to wait until the end of the year. It's just a quick update, right? To get it through December 31st. Do it now. Do it now. Do it now. So I'm going to put my preferred vendors list back up here because there's some amazing women on it. It is an all-female list of vetted preferred vendors. We have bookkeepers, financial planners, CPAs, and EAs for taxes. All the people that you want on your team, they are on our preferred vendors list. They're also friends of mine, and I love them, and business owners. So we do recommend to go ahead and get that process started now. Okay. So, and we even have tax planners and things like that. So if you want to sit down and have more of an in-depth tax planning. So I'm talking about tax planning with this is the very, very like top, just the tippy tip of the iceberg when it comes to tax planning that I'm talking about, as far as deciding like what year do you want your revenues and expenses and putting money into retirement accounts. There's a whole heck of a lot more. There's a whole heck of a lot more that comes in the form of, really looking at entity types. Maybe you need multiple entity types. Maybe you want to employ your kids. Maybe, there's a whole bunch of different opportunities for tax planning. If you sit down with an actual person who's a tax planner / tax strategist, depending on what they call themselves, that person can actually sit down and do an even more in-depth review of things that you could change and do that might help you not just this year, but ongoing. So the things I'm talking about are a little more short-term because we're sitting in November, and I want to give you guys some quick wins because I think that can really help you make some progress. But again, and hopefully that gives you a little bit of a fire under you to go ahead and get your I won't say your stuff together. Get your stuff together between now and the end of the year. I want you guys to make that goal for yourself, to have your stuff together between now and the end of the year so that you can make the best financial decisions that you can. I always say, right? One of the things that I always say is that you cannot make decisions, right? The reason that we do our books, the reason that we have our financial information is not just for taxes. If it was, then it'd be fine to wait till March or April of every year. But we use it for decision-making purposes. So this is a great example of where knowing your profit and being able to think about next year versus this year and do a little bit of forethought can actually save you money, right? You don't want to give away money just because you're not paying attention. That's not a good way to do it. Most business owners are doing that because they're not paying attention. So just pay a little bit of attention and try to save a little bit of that money. Remember, look at it though, not just for this year. I want you to look at least at the next 2 years combined when you're making decisions, right? And talk to your accountant about that too. Because sometimes unless you tell your accountant, hey, your accountant is going to default to saving you as much as they can in the current year. Unless you tell your accountant, hey, actually, next year we're expecting significant growth. So it might be a little bit better to save, some of that for next year, right? Some of those savings for next year. And if they know that, they can help you even more to prioritize what's going to make most sense for you in your business, right? Okay. All right, my friends. Anybody have questions? Anything they want to ask? You guys are quiet today. You guys are very quiet today. We are live currently in my Financial Literacy for Women Business Owners Facebook group. If you're watching the replay of this, make sure you're in that group. It's a fantastic group. They are my people. We are also live on my YouTube channel, so make sure that you have subscribed to that. We're really focusing for the next year is really going to be highly focused on growing our YouTube channel. We're really excited about some plans for that. And we're live on my business page. So wherever you're watching me, hi. And I don't see very many questions. You guys are so quiet today. Come on. I had a coffee for y'all. I had a Starbucks coffee. Yes, it is definitely a Wednesday. Today is a day I have things stacked all day. So I am on camera pretty much the entire day today, which, is not too out of the norm, but it's going to be one of those days that I need a big old glass of wine at the end of. Okay, good. I'm glad you guys got help out of it. What are you guys going to do? Are you guys going to go ahead and sit down and start doing this stuff? Are you going to think about where do you want those deductions? Where do you want that revenue? What are the levers you can pull? I like to talk about the levers, right? You have levers in your business that if you know where you need to go, if you know where the goal is, you can pull a lever. So that's what I want you to really start thinking about when you are making decisions in your business is, okay, I know I want more profit next year, or I want, whatever you want, then you can pull a lever. Yeah, it's the 2020 ERTC is taking forever into time. It is, and it's really strange because 2021 people are getting, but the back 2021s are taking a million years. Let's see. So this is a really great, we were going to be doing a conversation on Zapier with one of our preferred vendors, but we were actually unable to do that. So I can give you her information, Marie Lyons. She does all the work with setting up systems and Zapier and things like that. But we couldn't work out the time to get her on this time. But hopefully we can do something around the realm of that later on at some point. Okay, let's see. I'm just looking through questions. Dana says, are there any negative reasons for electing S Corp status at the end of a really good year? If we pay all the payroll taxes now and run 1 or 2 payrolls, is that okay? So I've never done the late S election. So I'm not the best person to ask that to. It's absolutely an option. And I know people have done it. The question that I have is how long it takes, because I know it can take some time to actually get approved for your S election. So what happens in the interim? My concern would be if I haven't heard back, what do I do, right? If you're stuck in that like weird like middle ground, what do I do? And I'm, again, like I don't work in that area a lot. So you could, I personally, I'm gonna go off a little bit. I don't think I think S Corps are a bit of a racket. I don't think they're as beneficial as most people think, because when you're talking about S Corps, I want people to be making sure that they're doing, and you probably are, Dana, because I know what you do, but I want to make sure people are taking into account the QBI deduction as well when they're talking about S Corps, because I am not even an S Corp. And the reason that I'm not an S Corp is because it actually is more tax advantageous for me to not be an S Corp and to max out my SEP IRA instead as much as I can. I actually get less. I'm going to share, this might be a little bit intense, but I think if I can find it, there's a great calculator between the different types of business entities. It's a little bit it's meant for accountants. So it's not necessarily the most user-friendly, but it might give you some interesting information. So let me see if I can find it. It's through Intuit. Hang on. And it might be helpful because I just when I look at S Corps, I think a few years ago before the Tax Cuts and Jobs Act, yes, it made sense. But because of the fact too that your Social Security maxes out anyway, right? You have a max on your Social Security. I don't know. I'm skeptical. I've done this S Corp Selector for myself. I've run it probably 100 times this year because I'm like, really? Is it still not? And so the old rule where it was like, if you made over $70,000 in profit and things like that, I'm not sure that even really stands as much anymore. You have to look at your own specific situation. I'm going to find it and I'm going to post it. I can't find it right now. Oh, maybe I can. Hang on. This is what happens when I search for things while live. Here it is. Okay. So hang on a second. And I can even, if you want me to, I can even send this, but here you go. So this is the S Corp Selector. I just put it into the comments. It should be showing up on the Facebook comments too. I don't know if it'll post in the group, but it is an entity selection calculator. Again, it's meant more for accountants, but it is, but you can play around with it and use it. The important thing to make sure is that you're using all your income that you have. So that includes like your spouse's income, that you're adding that in and things like that within here. When it asks about taxpayer other taxable income, make sure you're including all your taxable income for your family if you're married filing jointly. And you can play around too to see like, okay, well, what if I put money into my SEP and things like that? So I want you to take a look. Okay, cool. Crystal's posting it. Awesome. Okay, Jackie's got me. S Corp status in late elections. It really depends on your specific situation. Definitely speak to your accountant. I am an S Corp and it was more advantageous. Yeah, each business is different. And so it's not that same bright line anymore. And I really want to make sure that people are considering the QBI deduction when they are looking at that, because it does have a big impact. And QBI is very confusing. QBI is the qualified business income deduction. It is super confusing. and it phases out. And then there's this thing about whether you're a specialized service, trade, or business. Okay. So like that matters. So there's a lot of little things with it. And even a lot of accountants aren't like super well versed in it. And if you tried to have me explain the QBI deduction in a 30-minute live, everybody would go cross-eyed. It's calculated different. So you can, but it's calculated differently. So that's why I tell people to use the tool. It'll show you what you get. Again, this tool is meant for accountants. So if it's really confusing, they have some like explanations and things like that, but you can at least get an idea of what makes the most sense for you at the end of the day. But it is confusing. I don't think an S Corp is bad. I just don't think it's all that necessary most of the time. And I think the admin side of the work piece, I've seen more people become S Corps that never should have been S Corps than I see people really benefiting from being an S Corp. I'll say it that way. I'm not saying there aren't people who are benefiting. There definitely are. You got to do it the right way. You got to make sure that you know your reasonable salary, that you're paying yourself through payroll, all of that. But a lot of people do it. I know people that have done it like in the very beginning of their business, and there is absolutely no benefit. And in fact, you're going to end up paying more in admin fees and tax filings and things like that if you become an S Corp too early. So that is what I tend to see more out there and why I caution, because that is one of the things, and you'll see it in this group when people are like, I need ideas for tax savings. You will have all these ideas and at least like 20 people will be like, just become an S Corp. It saved me tons of money. And I'm like, did it though? Are you sure? Like it may feel like it because of the way S Corps work and how the processes around S Corps work. It may feel like it because you're maybe not paying as big of a check at the end of the year, but all in, you may not actually be paying that much less in taxes, if any at all. This wasn't about S Corps, but you got me started. Yes, know what you're getting into. You want to have help too. I don't think there's many, like S Corp is not a DIY situation. So it really depends. All right, guys, y'all are my favorite. Yes, thank you, Jackie, backing me up on it. Okay, you guys are amazing. I love y'all. I will be back in a couple of weeks. So next week's Thanksgiving. I think I'm back the week after. I can't remember. But let me know also what you guys want to hear about, what we can be talking about right now, because we don't have a lot of our content planned out. So we're kind of working on what our content plan is going to be between now and through the first few months of the year. So I'm always interested in hearing what you want to talk about. And maybe we do another one about S Corps more in detail. I can actually play around with this little tax entity calculator if you guys think that would be interesting to watch me do, which is what I just do in my spare time. I'll just put the camera on and do it. All right, you guys are awesome. I love y'all, and we will talk soon. Bye.